Welcome back to part 2 of our video lecture for chapter number 8, where we're going to continue learning about the calculation of depreciation. In part 3, we're going to learn about calculating the gain or loss on the sale or other disposition of business property that we're depreciating here in parts 1 and 2. So here in part 2, let's depreciate real estate. Remember that real estate is anything that's not personal property that we had depreciated in part 1. Now, real estate has to be divided up into two parts. We know that land costs is not going to be depreciated, but you get to deduct it at the time you dispose of it when you sell it. And everything attached to the land, like the building called improvements, that's what we're going to depreciate here in these calculations. Now that improvements have to be allocated into two categories. One is called residential real estate, where people live, like an apartment, like a condominium, maybe a single family home. And we're taking the viewpoint of the landlord, not the tenant. The landlord is making money. The landlord is going to be able to deduct depreciation on the improvements to this property. And residential property is assigned a life of 27 and a half years. Now, if the property is not where people live, non-residential property, like an office building, a factory, a warehouse, these are used in business or maybe even rented out by a landlord. But in either case, people don't live here. And we're going to assign that type of property a longer life, 39 years. The calculation for depreciation uses the straight line method most of us are familiar with that we had learned in a previous accounting class. Now, if you remember from the last part 1 video, that personal business property had to be using what we call a convention called either half year or mid-quarter convention. Convention is just a special calculation in the first and last year of its depreciable life. Now for real estate, we use another convention called mid-month, meaning that whatever month you place that real estate into business use, we're going to take depreciation from the middle of that month to the end of the year. And then the next year you take a full year, and the next year you take a full year. And the last year, be it this residential life or non-residential, in the last year, you just take the remaining months you didn't depreciate in the previous years. Now we don't need to do the actual detailed calculations like we had seen or had not done for personal property, because for real estate, we also have depreciation tables given to us by the IRS. In our case, those tables are on this page of our textbook and re-shown here on this slide. Either residential or non-residential. Now you can see 12 columns for representing each of the months of the year, and you're going to use the column for the rest of that asset's life based upon the month the asset was placed into service. Like right now, for me, it's the month of February. So I would use any residential property placed into service this year in this month and use this column for the rest of that asset's life. So I take the depreciable costs and I'm going to multiply it by this 3.182%, and that's going to be my depreciation for the first year. And then the same depreciable costs I multiply by the second row for the next year and the third year and so forth. You notice they kind of bunch the years together, but this footnote at the bottom kind of implies that there's some rounding error, and just for displaying purposes, they kind of bunch the two rows together here. But the real depreciation rates, probably it's 0.001% off, is actually shown in the IRS publication that I have linked in our Lao Lima chapter resource folder. Okay, so again, you identify whether it's residential property or non-residential, then you pick the month that you had placed into service. Whatever month you identify, you use that column for the rest of that asset's life. So here's an example where we have Gwen buying a residential property in the month of August for a total cost of $290,000. That includes land of $50,000. So we know you can't depreciate the whole $290. You have to reduce the total price by whatever we allocate to land, and then that comes out to only $240,000. And now for each year, we use the same costs going down this depreciation schedule, and we multiply it by the rate you would see for month number 8, again in the residential table, month number 8. So this is the column you're going to be using for the rest of that asset's life. So you can see the first two percentages shows up in this example here. And all you do is multiply out to get each year's worth of depreciation. Let's move on to the next topic, going back to personal business property being depreciated. Again, we had covered that back in part 1 video. There's 3 types of depreciation for personal business property. Here, this new one called 179. Let's call this number 1. And then number 2, we had briefly seen in just one slide in the part 1 video called bonus depreciation, which we saw was 100% we can deduct right away in the year you place the asset into service. And then the main thing we had learned in that first video was the maker's depreciation, be it the 5-year or the 7-year property, or now in this slideshow, this program, part 2, we saw real estate being depreciated for makers. But again, what we're doing is only looking at personal business property, not real property, not real estate. So the order you take depreciation for personal property is 179 first. They call this an election, so you don't have to do it. You choose to do it if you want to. Then if there's any costs left over, then you deduct bonus depreciation. Bonus is typically automatic. You do take it. And you can see here, you take everything. And if that's the case, there's nothing left over to deduct for maker's depreciation. So all that time you would think, oh, learning makers, no sense because we've already deducted everything. The thing is, again, 179 is an election you don't have to do. And you can elect not to take. You elect out taking bonus. That means now you have all that cost to deduct under makers. And there may be reasons why you don't want to deduct the whole thing in the first year. These two only apply to the first year you place the asset into service. There may be reasons why you want to extend the cost out, being deducted over more years to spread it out. In all 3 cases, the maximum you can deduct is that original basis, the unadjusted basis. You cannot deduct more than that, but you may want to time it to your benefit to extend it out over a longer period of time. Okay, going back to 179, there's a dollar limit you can deduct, and that's $1 million worth of assets you place into service. Okay, that's a dollar limitation. But now there's another limitation called purchase limitation. If you buy during the year more than $2.5 million of personal property, which includes this 1 million now, if you buy more than 2.5 million, you gotta reduce this dollar limitation for every dollar you go over 2.5 million. In this example here, if they buy 2,696,000, you went over by 196,000 over that 2.5 million here. Yeah. So you gotta reduce your $1 million deduction by this 196,000, leaving you only 804,000 to deduct as 179. Now the rest of what you had bought here, the rest, you can deduct as bonus. This number 2 now, right? And if you elect out of bonus, the rest can be deducted under the maker's depreciation. Okay, number 1, 179. And if you have leftover, bonus. And if you elect out a bonus, makers. There's another limitation for 179. Again, we saw $1 million limit, 2.5 million, sometimes they call it a threshold purchase limit. And then there's an income limit. You cannot deduct more than your business income of 179 for the year. In other words, you cannot generate a business loss by deducting 179. If you claim more than the amount that will bring you down to zero profit, then any excess you can carry over to next year's 179 deduction and limit it to that year. This footnote down here is kind of applicable, kind of telling students that because bonus is 100%, because 179 is up to $1 million, probably there's nothing left over to deduct, or you don't deduct 179. That leads everything to bonus. Remember, this is first, bonus is second, makers is third. So probably for the next few years, for most small businesses, if they don't want to spread the costs over the 5 or 7 years, they'll probably deduct everything for bonus and reduce their income for the current year. Okay, let's move to another rule. And again, this is for personal property, not real estate. Sometimes property can be used for both business use, and personal use. Personal meaning not business. Like maybe you're using your automobile and you're driving to school, you're driving around to do errands. That's all personal use. But then you have a business. You drive not from home to business. That's non-deductible commuting. But you drive from one business location to another. You drive to a customer's office. You drive to a vendor's location. You drive to a construction site for business. All of that is business use. And as long as that asset is business use, you can deduct and depreciate it. The amount that's allocated to non-business use, personal use, you cannot deduct. You cannot depreciate. Now, when your business use is greater than 50%, you have to allocate the amount to business use and depreciate it, like we've been learning. 179, bonus, makers, but the amount that cannot be allocated to business. You can't do anything with it. Okay, that's assuming business use is bigger than 50%. Now, when your business use is equal to or less than 50%, you cannot take 179. You cannot take bonus depreciation. Also, when you calculate the maker's depreciation, you cannot use that double declining, 200% declining balance. You cannot use that 5 or 7 year short life classification. You have to use straight line method of depreciation. You have to probably use a longer, maybe 10-year life for depreciation. That's if your business use is 50% or less. Again, business use more than 50%, you still have to calculate the business use, but now you can take 179, you can take bonus, you can take makers on that business use. Okay, that was listed property. Let's look at another limitation for this time just automobiles. They use the word luxury automobiles, but it applies to basically any passenger automobile, any light-duty truck, any automobile less than 6,000 pounds. There's a dollar limitation you can deduct for depreciation, and it's based upon the year you place the auto into first business use. So in this example, we're assuming putting into service in 2018 for business. So you calculate out your 179, you calculate out your maker's depreciation, and then the maximum you can deduct in the first year is 10,000. Now, if in the first year you also take bonus depreciation, you can tack on another 8,000. So whatever costs you cannot deduct in the first year, now it's going to be deductible in subsequent years only for maker's depreciation. I guess you can have any carryover for 179, you can also deduct it in future years. But the future years also has its own dollar limitation. Like here, a car placed into service in 2018, and the next year the maximum depreciation you can deduct is only 16,000. And then in the third year, 9,600, and in the fourth and subsequent years, 5,760. And because we have these dollar limitations each year, you still may have bases you haven't deducted even after 5 years. So you keep on going using the same amount as a limitation for future years. Okay, this is a special limitation for automobiles, for passenger, light-duty trucks under 6,000 pounds. There is another limitation if your automobile, another set of rules for automobiles weighing more than 6,000 pounds. Again, the first of the three depreciation you take is 179. And instead of that $10,000 limit we saw in the previous page, the limit jumps up to 25,000 for 179. The thing is, because it's also heavy, there is no dollar limit for bonus. You get to deduct the whole thing if you fall into this category. And if you elect out of 179, if you don't elect 179, elect out of bonus, then anything left over is using the makers without those dollar limits we saw in the previous page. Again, this is for heavy, like a Chevy Suburban, a Ford Expedition, a Hummer. Again, this is after now the listed property limitation. You are now applying this luxury automobile limitation. So we have an example. Let's take a look at the answer already. But the question is that we have Jim, who has a cost of $52,300 for his automobile placed into service in 2018. So the numbers we saw a couple slides ago will apply to him here and subsequent years. So we take the cost and we take, here in this example, they're taking maker's depreciation first. So the 5-year life, the first year comes out to 20%. So we extend out, and this would be the depreciation if he had used his automobile 100%, but we're told it's only 60% business. So we apply that business percentage to come out with the amount of maker's depreciation for the first year. But if you remember, there was a $10,000 limit for the first year. This $10,000 applies to makers and 179 depreciation. And you don't compare the $10,000 to this business percentage here, but you got to reduce that limitation by the business percentage to come out with a new revised business dollar limitation. Now you compare it to your business deduction. Again, this would be makers, but it also would apply to 179 that they didn't show in this example. And the maximum of makers and or 179 would be 6,000 for the year. But we saw there was a total of 18,000 if you include bonus for the year. So that's 8 more. But then you still apply that business percentage for Jim to come out with another 4,800. So that would be $10,800 max for the first year. Anything else not depreciated now can be depreciated in future years subject to whatever business percentage applies. And again, it should be uh, more than 50%. Otherwise, if it goes to 50% or less, you may have to recapture some of the previous year business use. What you could do is not take 179, not take makers, and then take the whole thing as as bonus. But again, bonus would be limited to max of 18,000. But you still apply the 20% limit and you still come out to that same 10,800. And again, whatever is left over can be used, deducted using the makers in future years. Let's move on to our last topic for this part 2 video, and that's deducting, so-called amortizing, not depreciating, not tangible but intangible business property. So what you have to do is identify the category of intangible assets being used by your business. The best place to do this is to take a look at the instructions to the depreciation amortization instructions. Again, the form is called 4562. And if you take a look at the instructions, it'll tell you different categories of intangible assets and assign it what we call a Internal Revenue Code section number and assign it a certain class life. In this example, 15 years for an asset called goodwill. There may be other assets with other class lives for intangible, and it'll give you the section number for those. The calculation for amortization is not that double declining balance method, but the straight line method. And we don't use that half year or mid-quarter convention. We basically look at the closest month and amortize it for the first year for the remaining months in the year and go again straight line for the rest of the life. So here's an example. Our company here, Fiona Ware, has bought another business here in May of the current year, and the total purchase price is $980,000. So now we would allocate that $980,000 to the specific assets in this new business we bought, allocating that $980,000 to land, to building, to equipment, maybe even some intangible assets like a customer list, some maybe a patent, licenses, and then anything we cannot identify more that we had paid for is assigned to that infamous goodwill asset here in the amount of $54,000. Now in a financial accounting class, this goodwill asset will just sit on the accounting records not being amortized, but only written off at the time you resell this business, or maybe you have what they call an impairment and you can write it off. But for tax purposes, we can amortize it over 15 years. So we take that amortizable cost and divide it by its life. And because we had placed into service in May, that means there's 8 more months left in the year. So we just extend out to get the depreciation for the first year, and here's the remaining annual depreciation until you use up all of that 54,000. Again, we're using the straight line method here. Let's see if I can zoom in on the tax forms. So this is the form you would use to report depreciation and amortization. It's called 4562. Looks like I have to move the whole form here. So this form, 4562, is used both by individuals and other business entities like partnerships and corporations. So in part 1 is the 179 deduction. Remember that $1 million limit and the purchase threshold limit of $2.5 million. And then there's an income limitation that you cannot generate a loss with 179. This is the first of the three that you would choose to deduct. Okay, so uh, if you kind of read the words, it doesn't show you the dollar amounts, yeah, I just mentioned. But you're told to look at the instructions, and the dollar limit here would probably be something like a million. Yeah, a million. I guess that's 6 zeros. And then the threshold would be something like that, 2.5 million. And you cannot generate a loss. So they ask you to identify your business income, and you cannot make it go below zero. And the nice thing about 179, you can pick the specific personal property that you want to deduct. And you had put the whole cost over here, but then you don't have to deduct the whole cost. You can choose how much of that cost you want to deduct. Now, if you choose more than what you can deduct because of the income limitation, you can carry it over, whatever you cannot deduct, carry it over to next year. Next year, it's subject to that same income limitation. Okay, that's 179. Now, if you have anything left over, you can deduct it using the bonus depreciation. And notice they don't have the word bonus here anywhere written out. They call it special depreciation allowance. And it's 100% the whole amount of that personal property. You can actually create losses. Now you can use it to offset other non-business income, at least up to 80% of that other non-business income for the year. And if you still have extra, what we call net operating losses, net business losses, you can carry it over to next year. So a lot of times there's nothing left over after 179 in part 1 and bonus here in part 2. But again, the bulk of our chapter, we spent a lot talking about maker's depreciation here in part 3. So we identify the class life. Again, the common for personal property is 5 and 7. Here you can see residential and non-residential already plugging in the lives we've seen before using the mid-month convention, straight line calculation. We enter the dollar amount to be depreciated here. I wish they would have another column here for the rates, yeah, so we can multiply it by the cost to get the amount of depreciation for the year. For the personal property, we put in the cost basis here. The recovery period would be probably one of these numbers here. Again, ours is the 507. Convention, either the half life or the mid-quarter convention. And then the method would probably be double declining balance method, or you can elect to choose the straight line method. And then multiplying it by the rate times the cost will give us the depreciation for the year. Now this whole section right here is only used for calculating depreciation for new assets you place into service for this year. If you have older assets still being depreciated, you don't report it in this table. Here they tell you to just plug in all of that previous year's depreciation, previous year's assets, current depreciation in this line 17. So you gotta have some type of worksheet. You gotta have some type of maybe software, fixed asset software to calculate or keep track of all of the stuff you've been buying and accumulating it for prior year's purchases and then for current year's purchases. Okay, so that's part 3. Let's take a look at the backside of this form. I guess I need to zoom in off to the right side here. So the top of page 2 of this 4562 is the term we had seen previously called listed property. Again, that mix of business and personal use. And the key thing here is that we try to keep our business use more than 50%. So just like the front page, we enter the same information, just depreciating the business portion. You can see here, we can still take 179. We can still take bonus. But then if the business use goes to 50% or less, You cannot take 179. You cannot take bonus. You have to use straight line, probably over a longer life than 5 or 7 years. Okay, so that's listed property. And then for automobiles, which is listed property, automobiles, you still want even more information being reported, making sure that you're legitimately claiming only the business portion, following policy, having good records. Okay, the last part of this page 2 of Form 4562 is to report amortization. And you have a description here, the date you put it into first service, the amount you're going to amortize, and the code section, again, identifies the different categories of amortizable assets. So again, the best place to go is to take a look at the instructions to this Form 4562 to see which category your intangible asset falls under. And then it'll give you a code section, and then it'll give you some kind of life in years. And you use the straight line method to calculate out your amortization. And just like depreciation, all of this detail being reported is only for stuff you place into service in the current year. Anything that you had placed into service in previous years that are still being amortized is plugged in as one figure here in line 43, then to get a total of amortization in line 44. This total amortization in line 44 is then carried back to whatever tax form your principal form you're using, like the 1040 or the 1124 corporation. But you won't see a line called amortization there. You probably have to plug it in as a other classification, other deduction in your tax return. Versus depreciation, there's probably is a line called depreciation in your main tax forms. Okay, let's stop here, and when we come back for part 3, we'll learn about calculating gain and loss on these assets we've been depreciating.